Hey, what's going on YouTube, and welcome back to Tech Conversations. I'm your host Guillermo. It is May 20th. Hope you're all having a great day today. The stock market is green. I am up $1,600 today, or about 1.6%. So we'll see what the rest of the day brings us. Now in today's video, I want to talk about a rare strategy that not a lot of people know about, but it's very easy to implement. This will be a bearish strategy, and we can make a lot of money on the downside here. So before I get into this strategy, guys, all I ask is you guys hit the like button down below and subscribe. It really helps out the channel. For this strategy, I'm going to use ticker symbol PENN, Penn National Gaming. Now keep in mind, this is just a random example I'm showing you guys. Please don't copy this exact same trade. This is just for demonstration purposes here. So what we're first going to do is we're going to go over to the options here for this particular stock. Now let's first go ahead and clarify what our goal here is. So our goal here from this strategy will be to benefit from a drop in price of the underlying stock. So in other words, the market forecast for this particular strategy should be a bearish environment or a bearish stock. And so the ideal stock we want to use for this is going to be a stock that you believe has a very high chance of dropping in price, whether it be due to earnings or maybe an FDA approval that was revoked, or maybe there's just an overall market crash. Every stock is dropping a lot, right? It really depends. But ultimately, you want to find a stock that you are very bearish on. So let's say I'm bearish on Penn National Gaming. And again, this is just an example here. Here's what we're going to do. So what we're going to do, of course, is that first of all, let me talk about the strategy. It's going to involve 3 contracts, 2 different strike prices. All are going to have the same expiration date, and all are going to be of type put. So I'm going to go over to puts. So we're going to be dealing with puts because, again, this is a bearish strategy here. So here's what we're going to first do. The first step we want to do here is we're going to go over to sell. Okay, so we're going to sell a put. And I'm going to go over to May 28th because May 21st is tomorrow. So I want to give our trade more time to actually, make money here. So what we're first going to do is we're going to sell a put. Now we're going to sell this put. It's going to be an in the money put option. Now remember, there's difference between in the money, at the money, and out of the money. So at the money is where the share price and their stock, the strike price, are as close to each other as possible. So here the closest strike to the share price of 77.15 is this. So this would be at the money. Everything above this at the money option for puts is going to be in the money. Right, so for puts, in the money is where the strike is above the share price. Now, all of these that are below this at the money option down here, all of these are out of the money. And as you can see, these are going to be a lot cheaper than in the money options. So again, the first thing we're going to do is we're going to sell an in the money put option. So I'm going to go ahead and I'm going to choose the $78 strike. So for selling this put, I'm going to receive $3.33 a share. Now remember, each contract here controls 100 shares. So we're going to receive about $333 for selling this put. Now there's a problem here because in order to sell a put just by itself, you need to put up collateral. So if I wanted to sell this put, I'd have to put up $7,800 in collateral. Well, let's just assume we don't have that money. And that's fine. You don't need it for this strategy. So what we can do then to kind of counteract that is we can go ahead and we can buy a put. But we're actually going to buy 2 put options. More specifically, we're going to buy 2 out of the money put options. So now I can come down here and I can go ahead and buy one of these puts. Now you're going to have to kind of mess around with what strike you want to choose by going over to the options profit calculator and kind of taking a look at what your profit or your reward to risk ratio looks like. But I'm going to choose the 73 strike here. So I'm going to go ahead and click on that. Now, again, we need 2 of these. So this by itself is a put credit spread. We don't want that. So I'm going to click this drop down. I'm going to custom, and I'm going to do 2 here. So this will be 2. So now, as you can see, I'm buying 2 puts, 2 out of the money put options, and then I'm selling 1 in the money put option, and I'm able to do this. Now for doing this, I'm going to receive a credit. I'm going to receive $74. And again, you can kind of take a look at this expected profit and loss chart, kind of telling you what your max loss is, max profit is. As you can see, max profit is very high here, but we'll go over to the options profit calculator here in a minute. But if we continue here, we are going to have to put up collateral. So I would have to put up $500 in collateral for this trade here. And again, depending on how far away the strikes are from each other, you'll have to put less or more collateral. So again, definitely mess around with that, guys. But now that we have this here set up, let's talk about quickly a couple of things here. So depending on what strikes you choose, sometimes it'll be a credit like you see here. Sometimes it might be a debit. Sometimes you may have to pay and still put up collateral. The other thing, of course, is that your max reward here, you can calculate it, but it's kind of messy to do it. But I will say it will happen when or if the stock goes to $0. Our max risk, however, that is defined. That will be the collateral that you're putting up minus any credit that you received. Or if you don't receive a credit and you put up a debit, it'll be, you know, the collateral you put up plus the debit that you're paying. So anyways, let's go over to the options profit calculator. By the way, this is called a put ratio backspread. We've talked about the call ratio backspread, which was a bullish strategy. This is a bearish strategy. So it's called the ratio backspread because we have one put or two puts that we're buying to one put that we're selling. So a 2-to-1 ratio. Sometimes people do a 3-to-2 ratio. So sometimes they might buy 3 puts and sell 2 puts. Again, that'll really depend on the individual. And you can definitely kind of try that out and take a look at how that would look like. But let's go to the options profit calculator. Let's take a look at what this trade looks like. So underneath spreads here, they actually have a ratio backspread calculator already, which is kind of neat for us here. So we'll go in here and we'll go ahead and let's take a look here. So a call ratio backspread, which we talked about, strongly bullish. This put ratio backspread, which is what we're talking about now, strongly bearish. So I'm going to go ahead and say PENN. We'll get the price here. And then we'll just set up the exact same trade that we just set up on Robinhood over there. So that was selling the 78 and then buying the 73. So let's go back here. Let's start with writing the $78 strike. Remember, we chose the May 28th expiration date. So make sure you're choosing the correct expiration. Puts are on the right, calls are on the left, and we chose the 78 to sell or write. And then let's buy our out of the money put option. Again, should be the same expiration. Puts are on the right, calls are on the left. We chose the 73 strike. And of course, we're doing 2. So here we're going to get a $68 credit. So very similar, guys. And then I'm going to go 55 to, let's go 85 here. And then let's calculate this. So again, this is a bearish strategy for the most part, guys, but there are some surprises in here, which we'll talk about. So here's what this looks like. So our entry cost is $68. That's a credit that we're receiving. So we're actually getting paid to enter this trade. Now we are putting up some collateral, as we saw, $500. $500 minus the credit we received, $68, gives us our max risk of $432. That'll happen if this is $73 on expiration date. Now that is the strike of the put that you bought. So that is worst case scenario. You do not want it to be this price on expiration date. Now we take a look, max return, almost $7,000. And that'll happen if the stock goes to $0. Now that's probably not going to happen. But the farther this drops, the more money you make. Again, that's the benefit of this. This is a bearish strategy here. And then it gives you your break-even points on expiration. And then the probability of profit here, about a 60% profit. Now, what's very interesting here, right, is that, and what's very odd, is that in some scenarios, with this one included here, sometimes you make money if the stock goes on a bull run, right? So if you look up here, we can actually make money up here as well, right? If on expiration date, for some reason, the stock goes in the opposite direction, it goes to $78 or above, we have $8, which is the credit we received. And that makes sense because if on expiration date, this stock is $78, all of these expire worthless, right? These puts you bought expire worthless. This put you sold expires worthless. So these will expire worthless. And since you did receive a credit, you would make $68 as long as it's at $78 or above on expiration. Also, again, As you can see, again, like I mentioned, the max risk happens on the strike of the put you bought on expiration. The more down you go, the less you lose. The more up you go, the less you lose too. So definitely different than buying a put, right? And we can quickly look at that here. So I'll go to pen here. This is a long put. So I just want to quickly show you guys here kind of the advantages. So if we go to May 28th and I buy that 73 put here and I use the same range, right? And we calculate this. So here's what buying a put looks like, right? So again, with buying a put, if it's at 73 on expiration, we lose all of our money. It doesn't matter how much higher you go, you lose all your money, right? If it goes up, if the stock's even higher, you lose more, right? Versus over here, you have this nice green on top. And so, you can kind of compare it here. This is a put, buying a put. Look at the probability of profit too, 21%. So it's a lot lower versus the probability of profit with this, which is 60%. But of course, you are risking more money. So again, it's kind of up to you what your risk reward ratio is. If you think maybe this could have a bullish move, you could also make money if it did go on a bull run. So anyways, this is the put ratio back spread. Now, the other thing, of course, that I want to mention is be careful with commission costs, because you are opening and closing 3 different contracts. Robinhood doesn't have commission fees, so we don't have to worry about that there, but some brokers do. The other thing, of course, is risk of early assignment, and that's actually where the motivation for this video came. Someone actually got assigned yesterday using this strategy, and they reached out to me. So remember, anytime you sell an option, there is risk of assignment. Now, being assigned before the expiration date is very rare. It's happened to me once. It happened to this individual yesterday with Lordstown Motors. So it does occur, guys. But remember, we're buying 2 puts here. One of these puts can definitely counteract that. So it's not something we should worry about, but it's something you should, know that it is there. Now, early assignment is generally related to the ex-dividend date. So if a stock has a dividend, and if you check the ex-dividend and your options expire on the week that, that ex-dividend date lies on, there's a bigger chance you'll be assigned early. So to avoid that, either just don't sell options on that ex-dividend date week, or close out 2 days prior to the ex-dividend date, just again, so you don't have to deal with that. So anyways, that is early assignment. Again, anytime you sell options, there is risk of assignment. It is very rare to be assigned before the expiration date. Usually, if you are, it's related to the ex-dividend. So anyways, guys, if you have any questions, feel free to leave them in the comment section below. Check out the Discord, check out BlockFi, link to them in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.